It went down, up, down, You might have had 20 trades in that, right? But the thing is, this whole period, you're ready, willing, and able. You can only sell, and you sell highs. You know how to sell. You can use pivot points, weekly pivot points, monthly pivot points, daily pivot points. You can use Fibonacci. You can use moving average crossovers. You can use price action. You can use anything you want. It doesn't matter. The only thing that matters is your alpha. Your ability, I'll describe it here, your ability to understand that you're a bear in this zone and your capability of carrying it out. Your alpha is not your winning percentage, and your alpha is not your profit. How do you measure alpha, by the way? FX Noob, we're not talking about my alpha. My decision. I'm just picking one. To me, I can trade anything you want. I just have to pick a direction and I'm done. So we're not talking about me in particular. I'm talking about, like Brexit, I would always be bear on pound on Brexit, but there are times when pound recovers like crazy because it's so oversold. Okay? Okay, profit is not alpha. One way to look at it is maybe profit over volatility. Okay? It's actually return over volatility, but okay. So what does this mean? What does that mean, guys? What can we use? Okay, what tool can we use to measure your return over your account's volatility? Did you know? Volatility. It's not spelled right, but I apologize. Okay, because I'm thinking 5 things ahead here. Professional investors will look at this. Okay? This is your alpha. Okay? What's another way of looking at that? What's another way? What besides calling it alpha? What's another thing we could call this? By the way, this is the most important statistic. I don't give a crap what your winning statistic is. Oh, well, 98% of my trades are a loser. No, your trading is a loser. What you just told me, if you told me you have a 98% winning ratio, 98% of your trades are winners, you just told me you don't know how to take a loss. And that is the most important thing. So if you don't know how to take a loss, you're fired. I'm not interested in investing. Disappear. Okay? Is that clear? So right? Or the other way is, like, why isn't, like, what if it said you make 150% a year? Why is that not enough information? You're like, that's good, right? It depends on a couple of things. Okay? One is let's go to this. If you are down 50% so that you can be up 50% or up 150%, I call this a pain to gain ratio. And the problem with this is you're too volatile. I don't want you to have my trading account down 50%. And by the way, for the math to work, you had to have excessive leverage to get from here to here. And by the way, so risk-adjusted performance says if your return is high, like 150%, and you got it because of leverage, which is risk, then your risk-adjusted performance is actually quite bad. Okay? And you don't want that. So people don't want the leverage. I mean, again, if you're taking 100% leverage and you're making 22%, it's just not cool. You're not doing well. But going back to this, your return, so that's the first thing they're asking you is how did you get your return? So they'll look at alpha versus beta. Okay? So let's say, I'll just pick a beta we could all understand. The S&P 500 is up 9% this year. And you made 90% return this year. How did you do it? Market moved 9%. You made 90%. How did you do it? Leverage. So there's a certain leverage that is tolerable or desirable. And if you don't go, if you don't have big drawdowns, it'll be more tolerable. If you were if the month earlier you were plus 30% and then at the end you were plus 90, you could have easily gone to zero as much as you went to plus 90. And that could be a random occurrence based on when you tested. And that's risk. Again, that's going to be volatility. If the investor doesn't know if you're going to be break even or produce 100%, they're just not interested. Okay, so again, volatility. So leverage is okay if you don't have the volatility of big lows. So if your lowest low was 5% and your highest high was 100%, people are not looking at the 100%. They're looking at the 5% losses. And they're like, well, that ain't bad because there was low volatility. And then, of course, you can tell them, well, don't look at the 100%. Look at that I averaged 5% per month. Okay? And you're like, oh, okay. And you're like, it's actually quite reasonable and achievable, and especially when I'm leveraged. But I'm not crazy leveraged, because if I was crazy leveraged, the volatility would be higher. Okay? So what risk-adjusted tool is common for investors to look at your return, your alpha relative to your beta, and then your return, right? Adjusted for volatility. What statistic do investors use to compare apples with apples? So you produced 50%, I produced 50%. You have more volatility. So let's say your typical loss, let's say, is 10%, and your typical win is 5%. But you might win, let's say, let's say 5 out of 6 months you're up 5%. 1 month you're down 10%. And let's say 5 out of 6 I'm up 5%, and the last 20% I'm negative 5. But right, and somehow I don't know if that won't work, right? But anyways, somehow at the end of the year we both produced 50%. I know that's not going to make sense, but let's just say I produced 50%, you produced 50%, and someone's got to make a decision on which one gets the money. And so what they're going to look at is not how much money you're making, okay? They're going to look at the volatility. And in this case, you have more volatility than me, so I'll look better. So now you're getting a ratio. Well, break-even doesn't produce a loss. We're not talking about win ratios. We're talking like percentage loss, like your account going down 10% on your worst month, and my worst month, the account drops by 5%. So your volatility looks like this. You're up, down, up, down, up, right? And mine looks like up, down, up, down, okay? And even if our overall average, so maybe my slope is different. I grow slower, you grow faster, but your drops are bigger, right? So that's probably what it is. Your returns look like this, and my returns look like this. Okay, and at the end of the year, we both end up at 50%. Okay, which one gets the money? So we use a tool for this. So a risk-adjusted performance is what people look at. This is why I say your winning percentage. I don't think real investors even look at that. The real red flag is when you have a high winning percentage and they're like, oh, this guy's a loser. Doesn't make sense to you if you don't know anything, but if you know something, then it makes sense. Like, people don't want that. People want to know when things go bad, you're going to protect the money. If you are emotionally attached to your winning percentage, you will never take a loss when you're supposed to, because it'll ruin your precious little percentage. People are concerned about their money, bro, not your percentage. Okay? So what we look at is, drum roll, please. Oh, I have a drum roll, don't I? Or is it just not working? Let's see if I can make the baby cry. Yeah, it just doesn't work today. It's weird. These tools are weird. One day they work, the next day they don't. So anyways, drum roll, please. Okay, you ready for this? So you want your return, and it could be anything. Obviously, you want a positive return, not a negative return, because then it doesn't matter, okay? But what you want is low volatility. So we might both make 50% a year, okay? But your Sharpe ratio is 11, and I'm 44, okay? And they're going to choose one over the other, even though we made the same amount of money. Yeah, you can go into Z-scores and stuff. I had to do Z-scores and calculate them by hand as well. Honestly, I don't remember. But Z-score is another apples to apples one, but and there's more than one Sharpe ratio. You know, the Bill Sharpe ratio if you want. But the point is, I'm trying to get you to think that the return isn't the most important thing. How much money you make isn't the most important thing. Okay? It's not your profit. Okay? And it's not your winning percentage. So most amateurs traders that want to trade other people's money, they think if you make a lot of money, investors will invest. No. Then they say, well, if I have a huge winning percentage, like I almost always win, I will attract clients. No. Both of those are fallacies. And it's a paradox, isn't it? But you're going in the wrong direction. So I think the other day I said people are asking the wrong questions, like how to go the speed, how to get a spaceship to move the speed of light so we can go visit stars in another galaxy or another universe or even another solar system. And like, it's the wrong question. You need to be building a warp drive. Different thought process completely. Okay? So you'll have to be prepared for that one day. So I want you to think about it this way. Make a reasonable return. Okay? Rich people are not interested in getting rich quick. They're already rich. Poor people want to get rich quick. Okay? It's a dream. Okay, cool. So you want a reasonable return. So now we're not really, so when you're an absolute return fund like we are, Forex traders, you're not supposed to use a benchmark, but your client doesn't know that, so they use benchmarks. What I mean by that is the S&P 500 is up 9%, right? Year over year or year to date. The NASDAQ is up 13%. Might even be 23%. It's not 23, but it's not 13. Let's just change it so it's more reasonable. Okay. Okay. What do you need to make so that customers are willing to give up those investments? What do you need to do to lure them away from, because this is your competition right now. You have to say somebody like, Billy, instead of investing more money into the S&P 500, give me the money. I'm a Forex trader. How much do you have to produce to be the better investment? Well, these could be considered your discount rate. They could have made the money anyways by giving it to the S&P 500. So if you make 30% in Forex, they're still going to discount it by 15% and say, well, you only really gave me 15% over what I needed to do anyways, right? But Ash is right, like 1.5% compounded, it would beat that. Okay? So like, I'm guessing if you did 2% a month, that's got to be about, what, 33% compounding? Minus the 15 and they're way up. Okay? So yes, so now the next thing they would do is risk-adjusted performance. If NASDAQ was up 15% this year, but was also down 30%, do you understand how volatile it is? So now they're going to do risk-adjusted returns. And even though the NASDAQ's up 15 and the S&P 500 is up, we also know the S&P 500 down was negative 30%. And now it's up, right? Up 9%. So you would do a risk-adjusted performance. How much pain did you have to take before you gained? Cool. And if they looked at you and you had 100% more than the NASDAQ, but you had, let's say, I'll just make up a number, 50% less drawdown, then risk adjusted is way in your favor. You will provide twice as much money for half as much risk. Now you're in business, son. By the way, it's not the money. It's not the money. It's not the winning ratio. All they're saying is, if I gave you 100K, what's your worst month going to be? And you say, well, my 3-year track record shows my worst month was negative 5%. Now that's pretty good. What if your worst was negative 8? Okay. What if it was negative 10? Okay, these are recoverable. Okay, you can recover from these. If you show negative 20, F you, you're fired. They push you out the window. Okay, they push you off the cliff. You're gone. You're dead. You're out of work. No one will hire you. No one will invest in you. You're dead. As a Forex trader, as a professional money manager, you're dead. You're fired. It's over. It's gone. Goodbye. So, how close to this threshold do you want to get? And by the way, that's not a hard and fast number. It might be negative 15%. And people are like, dude, when I look at your risk-adjusted performance, your numbers are crap. There's just no way. So It's basically the investor's discount rate or risk tolerance, right? So how close to that threshold do you want to get? How close to the event horizon? Like if you hit -20, it's over. You get sucked into the star and you're dead. And there's nothing you can do to fix it. Okay? So how close? So maybe it's 10, maybe it's 8, and this is going to be depending on how much risk you are taking. Because remember, if your worst drawdown is -10 and my worst down is -5, it's not that you are a worse trader, but you're probably more leveraged relative to your account size, which means your highest high is going to be higher as well. So maybe my highest high is +10, right? So my pain to gain ratio is, at least the volatility side of the Sharpe ratio is going to be like my worst drawdown is -5, but I usually produce 10, or let's say, but my highest high was 10, right? So now and by the way, if you're thinking about creating an average and then a standard deviation, and you're creating a slope of these returns, +3, +4, +5, +2, +3, -5, and now you're looking at this in an interesting way. But that's the next lesson. If you're doing returns, you're getting close to your own standard deviation from what your average return is. And then you can say, well, if my average 2.5% a month, why am I up 10% this month? But your clients are going to do this to you. Your sophisticated ones, maybe you're not your first ones, friends, families, and fools, and small people. But when you get institutional, they're going to say, okay, your average is 2, and we're looking at the slope here of your returns. But why is this out here? How did you get this outlier? And then they're going to look at your beta. Because now they're going to do alpha, your ability to generate 10% that month, even though your average is 2.5, and this would be your average, your mean. And so how did you get 10%? And you'll say, well, the period from September to December typically produce higher returns because we have a clear direction into the end of the year. And the stock market was up almost every day. And therefore, the market now, beta is the market. So the market during that month was extremely in the favor, right? Was way up at that point too. So you can say, well, the stock market was up 5% that month. It was just ripper on fire. And I outperformed because I have some leverage. But it was a good month in the markets in general. So we had a systemic rally. The tide came in and rose all ships. And with a little leverage, my alpha was in line with the beta. Okay? If it's not, then it's all leverage and there might be too much leverage. So anyways, so there you go. Your volatility is even more important than your absolute return. Do you understand that? And I've been preaching this for years and years and years and years and years. Your volatility is more important than your absolute return. Yes, you have to be profitable. You can't be a professional trader and not be profitable. You do have to be profitable, but high winning percentages are a red flag. Because your alpha is going to be based on leverage alone. And leverage is risk, and people don't want risk, so investors will not be interested. And investors are not interested in a high winning percentage because it just tells them that you're emotionally connected to your winning percentage, but not providing a return of value or managing risk. In fact, you won't manage risk to protect something that the investor doesn't give a crap about. So once again, you're like, I have 98% winners. Yeah, not interested, pass. So what is? You have to have a reasonable return in line with market conditions. Alpha has to be in line with beta. And you have to have low volatility in your portfolio, which means your worst month shouldn't be that bad. So how do you do that? You keep your lot size low. You keep your trading focused on analysis and trade plans. And when things are going bad, if you have a long-term point of view and you're having a bad month, you need to pull the plug quickly and protect your month. At least protect your month and just say, oh my God, we're on the 4th day of the month and I'm already down 4%. I need to back out. I need to back out here and reanalyze this. Like, what am I doing wrong? And you start having very serious conversations. Okay? Because you're like, holy crime, right? Holy crapola. I can't go -8 this month. I need to figure out why I'm wrong and tiptoe back in, maybe cut the lot size even further, just so you can start getting into some winning trades, and then you can build on the winning trades versus just throwing down more losers. And you realize this because you have a long-term point of view for your trading. Can you imagine now? You're concerned about your Sharpe ratio, not your winning percentage. But isn't that what you're supposed to be doing? You have reasonable returns for market conditions, which means you're not over leveraged, and you have low volatility in your trading portfolio.